What's up, everyone? Welcome to Investing by the Numbers. I'm Simon Thompson, and today we're going to discuss my stock market forecast. Like many of you, you're trying to decide whether to buy now or wait and buy later, and I'm in the same position, of course. I have $200,000 of cash on the sidelines, and the reason I share that with you is simply because I try to be transparent in this channel. You know, I'm not bragging, it's just there's always a bigger fish in the sea, so, you know, it's not about comparing or anything like this. It's simply the case of where I'm at right now. And you can also see inside my portfolio. I share a video and I'll show you exactly what I hold in my portfolio, which I started building in very late 2018. And you can see every detail of that inside the video. I'll link that below. So I'm trying to figure out whether or not to buy now or wait. And I'm going to build a case for the bears as well as the bulls. And I'm going to share with you at the end of this video exactly how I'm approaching investing over the next several months and the next even year. So let's begin by talking about the case for the bulls. And numero uno on this list is stimulus. So this is their big weapon. The Fed has basically said they're willing to print as much money as needed, and the policymakers just have to decide how to spend that. Of course, there's been over $2 trillion in stimulus so far. The House Democrats have passed a bill recently that may pass the Senate or it may not. That includes another $3 trillion of stimulus, and President Trump has said from early on that it could be up to $6 trillion in stimulus, plus he wants to do a plan that supports rebuilding America's infrastructure. So I have no doubt that more stimulus is on the way. It's just a matter of time, and it depends on exactly where it goes. But this is pretty much the core argument as to why you should be a bull. It's the idea of don't fight the Fed. These guys are out there just printing, and it is going to prop up the entire economy. And that really brings us to our next point, the almighty US dollar. And a lot of people think that because the US is printing so much money that the dollar is going to be devalued, but actually it is very unlikely that that's the case, and that's because the world runs on US dollars. This issue is not a US issue, it's a global issue, and a lot of these poorer nations, they are printing money as well, but what happens is when they do that, their currency for sure gets drastically devalued, and they need to borrow in US dollars. And so there's a huge demand in the global economy for US dollars, and this is really the reason, because 70% of the world, as I mentioned, runs on US dollars, and they are going to be in high demand in a global crisis, and we've seen that so far. The US dollar has remained very, very strong despite all of this money printing. Next, we can talk about treatment and vaccine. Of course, remdesivir a few weeks ago was a big thing, and it showed, you know, an 11% benefit in a small trial, and that meant people were getting out of the hospital faster. And there's optimism because there's so many great minds working on this that we are going to find a solution that will mitigate the negative consequences of getting sick with this virus. And of course, the vaccine, there are some folks who think that it's going to come sooner than later. You have people like Bill Gates saying it's more like later in 2021, and then people like Trump who for whatever reason think that it's going to be at the end of this year that we get a vaccine. But the bull case is that we're going to have a vaccine, and that's going to solve the problem. And next we can talk about the idea of no second wave. So right now we are reopening the economy both in Canada and the US in various places, and it's very possible that we could see a surge in cases, but the bull case is that is going to be minimal. Of course, the other challenge is next winter. It's very possible that this viral situation gets even worse in the following winter, but in the case of the bulls, they're essentially ignoring this and thinking to themselves, it's not going to happen, we're going to reopen the economy, and we're going to be able to manage it through these two things that I mentioned before, treatment and vaccine, so we don't need to worry so much about next winter. So next we can talk about heat, okay, the potential effect of a warmer climate having a mitigating effect on the spread of the virus. And this is somewhat theoretical, but only 6% of the cases are happening in warmer areas of the world, and so there is some potential benefit to the heat, and there could be a slowdown in cases in the summer as things heat up across the world. Now, this is, widely debated and also hasn't been talked about a ton. I think because, government forces and agencies want to make sure that we're not just thinking, oh, it's going to go away when it gets warmer. Obviously, some people have been saying that, and other people are being more realistic. But it could have a potential benefit, and that's kind of one of the things that the bulls might be banking on as well. And then finally is herd immunity. And to oversimplify it, it's just when so many people end up building up antibodies after getting the virus, we get to a point where the virus can't easily transmit from person to person because there's so many people with these antibodies. And this may or may not actually be true, given the idea that the virus may be morphing over time. It may be changing just like the flu does. And so we don't always have the perfect antibodies to fight the flu each year because it's a different strain. So, but in this idea of herd mentality, it's maybe if the virus doesn't really morph much, we can just become immune to it. So this is essentially the case for the bulls. Again, the number one thing is the stimulus and the almighty dollar, and then just kind of banking that all these great minds are being put to work on this. So we have to be able to figure it out that way.
So one more thing that I wanted to cover that's really important for the case for the bulls is bond rates. Okay, so typically speaking, the alternative to the stock market is the bond market, and we can see here back in the 1980s, bond yields were as much as 15%. Now these are 10-year treasury bond rates. The average is around those times, and this is a very safe instrument for getting a return on your money. But as time has progressed, interest rates have dropped, and so too have the yields on bonds because they're very linked. And interest rates are basically zero now, and the bond yields are close to zero as well. They're under 1% currently. So they're not very attractive for investors, and the bond market is double the size of the stock market. So it's very possible that bond investors could be switching over to stocks, and potentially the surge would be massive. We can see here on this article in the Motley Fool that the bond market makes up about 40 trillion in value domestically as compared to 20 trillion for the domestic stock market. Now, quickly here, there's an article from 2018 that's talking about the end of TINA. And TINA is a phrase which means there is no alternative. And it's basically saying the equity market, the stock market, is the only option for investing. So all of these money managers with hundreds of millions of dollars under their control, they really can only invest in the stock market or the bond market. And in this case, this article was written when the bond market was, the interest yields were ticking up. And now, of course, that's no longer the case. So the stock market is really the only option. And as I mentioned before, a lot of money could be flooding into the stock market as it moves away from bonds.
Okay, so we can also make a case for the bears, and we can start by talking about turning the economy off and then turning it on. We've never done this before. It's a brand new thing, and we really just don't know if these businesses are going to be able to just suddenly come back, if it's not going to cost them so much in order to cater to the Roni, and potentially whether or not these jobs are going to come back, whether they'll be able to spend on growth, etc., etc., and we'll get into more of those things in a minute. So next we can talk about the potential spike in cases, and of course that could happen from the reopening of the economy. It could also happen in the winter if there's another wave, and that of course would put a massive strain on the economy once again, and the stock market would be very likely to respond in kind. Next, we can discuss unemployment. So unemployment has surged to record high levels in the shortest period of time, and those jobs aren't necessarily all coming back. Prior to this, unemployment was at all-time lows essentially, and now there's this huge spike in unemployment. And when we think about the airline industry or cruise lines, a lot of those jobs are not necessarily going to come back anytime soon, as those industries will be changed for a very long time. Plus, you think about restaurants, hotels, a lot of these businesses are going to have to take extra measures and also just won't have the revenues potentially to be able to support their own the growth of their businesses, and that means they may have to be laying off workers or running with skeleton crews, this type of thing. So unemployment is potentially going to stay a lot higher than people expect, and we see a lot of companies, already cutting their expenditures, and this also includes one of their greatest costs, which is their staff. So next we can talk about the debt bubble, and this is one of the biggest reasons for the case of the side of the bears, rather. So corporate debt is at an all-time high right now. Okay, this is a process where, if you've ever listened to Ray Dalio or even Howard Marks, two billionaire legendary investors, they talk a lot about this debt cycle, the short-term debt cycle, and right now it is at its peak, where corporate debt is at this all-time high. And even before this Roni situation started, there was a lot of companies that were already starting to get overextended and be in a potentially really bad situation if anything negative happened. And here, of course, we are in that situation. So there's a lot of potential bankruptcies and delinquencies coming down the pipeline because companies have such high levels of debt and they may not be able to service that debt. Next, we can talk about oil. So oil hit record lows recently. We've never seen oil futures go to below zero, but that happened this year. And there has been a bit of a rebound as demand has increased, but there was a point there where the headlines were about whether or not we're going to be able to even store all the oil that we were producing because we were running out of storage capacity. Now that situation has reversed a little bit. I'm speaking in May of 2020 here, towards the back half of May, and that situation's getting a bit better. But oil companies are really going to struggle. It may take a long time for oil prices to climb back up as demand may remain weak, and they are starting, different countries are starting to cut production, but that may take a while to catch up as well. So these companies are going to be cutting capital expenditures. They already are. They're cutting dividends, and ultimately 6% of US jobs come from the oil industry, and that industry is going to take a beating over the next year or two. Next, we can talk about interest rates. And so the Fed will typically lower interest rates during a time of economic hardship, and this is just a tool that they use to help spur economic growth because money becomes cheaper, people are incentivized to borrow, and therefore it gets the economy going again. However, they already cut rates down to zero. There's really nowhere to go unless you go negative, and that has a lot of potential consequences, which I can't get into right now. But the long story short of it is they basically have no power to do this anymore because rates are already down near zero. Next, we can talk about dividend cuts. A lot of companies are cutting dividends. The dividend cuts are racking up, and there's a lot of people who rely on dividends for income. It isn't just investment income that's extra for a lot of people. There's a lot of older people who rely on it in order to essentially survive and to pay their bills and to be a consumer. And since 70% of the US economy is based on the consumer demand, this really hurts, potentially really hurts consumerism in that older population of retirees. And next we can talk about, again, this consumer demand. So it's what I just mentioned. 70% of the US economy is driven by consumer demand. And as we come out of this big shock, not only are people going to potentially have their pocketbooks really hurt, and they may be feeling like they don't have the money to afford more expensive items like iPhones and cars and these kind of luxury goods, but also there's a mindset that tends to happen in human psychology where when all of this uncertainty happens, our immediate reaction is to be more protective, which means spending less, saving more, and making sure that we're prepared for the future because, hey, who knows what could happen, right? So it's very likely that consumer demand is going to remain weak, not only because consumers may not have the cash to spend, but also just from a mindset perspective. And businesses like retail, those who are selling clothes who are already suffering, they may see that their businesses collapse. So these are the J.C. Penney's of the world who are already going bankrupt, Macy's and so on, and they are suffering because of that. You could also see higher end restaurants suffering as people tend to want to eat at home more, be out less and also spend less money. Finally, we can talk about the Shiller, or not finally, but a couple more. We can talk about the Shiller PE ratio, which is a inflation adjusted 10-year average of essentially it's a measure of if the stock market is overvalued or not. And as you can see here, it is at a fairly high level, similar to where we were before the Great Financial Depression in 2008, 2009. Of course, it's not as high as we saw before the big crash in 2000. So next we can talk about buybacks, and this is part of the reason why the market may be overvalued. A lot of the gains that were made in 2009 were made because businesses were buying back their own shares. So they weren't necessarily growing their profits or even growing their revenues, but they were taking cash, buying back their shares, potentially even borrowing to do that, putting them in a situation where they have more debt and inflating their stock price, and the market is rising because of this. There are fewer stocks available, it's supply and demand, and this buyback has potentially driven stock prices up to this unsustainable level that we see with the Shiller PE ratio. And then finally, we can talk about global demand. We live in a global economy, very interconnected, and this situation is affecting the entire world, and it's going to mean that a lot of businesses across the world are going to not be buying. Consumers across the world may not be buying. Demand may be weak across the board, not just within the US or within Canada. All right, guys, before we go forward, please hit me with the thumbs up button. I appreciate the support so much. And subscribe and ringy ding dong the bells to stay notified. Thank you. I really appreciate it. So to wrap things up here, we can ask ourselves a question that's so popular in the media, which is what is going to be the shape of the recovery? And is it going to be a V shape, which is meaning that it'll come back really quickly? This is the case for the bulls. Or is it going to be a W where things crash again and then we recover later on? Or is it going to be an L shape, which just means we're going to see it be really flat for a long time before we eventually get some recovery? And in my view, I think we're going to see this W shape. I do think we're going to crash. I do think we will retest the lows and potentially even go lower. There's just too many big X factors in terms of the massive debt overload for corporations and also for individuals. I think unemployment will remain fairly high even after all of this is said and done. And I really think that with oil prices persisting, basically everything that I laid out in the case for the bears, these are going to be some major issues. And the number one thing really is that there is so much uncertainty. So yes, if everything goes perfectly, we could be in great shape in 2021. But with potential spikes in cases or closing down again in the winter, we could really be in a situation where things get far worse because we can't really withstand this type of shock over and over again. So when we factor in all these unknowns, I am being more cautious. I'm waiting for opportunity. And basically, I'm going to buy a little bit as things go down. And if we get to where we were before in March, I'll be making a major purchase at that time. And again, then just staying patient after that. It may bounce off of that and we may have an event where it goes lower. I'm really waiting to see what happens as the economy begins to reopen. I'm waiting to see what happens with Q2 earnings and Q3 earnings plus the winter. There is a lot to discover. So my advice is to stay patient. Of course, I'm not a financial advisor. You have to make your own plan for yourself, but that is my 2 cents. Okay, thank you so much for watching. I appreciate it. Leave me a comment below. Let me know what you think is going to happen, if you're a bull or if you're a bear, and I look forward to hearing from you.